Now, Al, we got one last segment here, and I know we have a lot to unpack and discuss, and I want to continue this discussion on retirement accounts, retirement strategies, but especially how the institutions are trading and investing long-term for retirement. Now, let's get into the IRA. First off, I want you to explain what the IRA is. We have two different ones. You have the Roth and the traditional. So what those are, but I want to really talk about how investors and how people can self-direct their own money, because think about this. Most investors have their money with an advisor or a broker, which is great. Then there's nothing that they have to do. Well, the problem is a lot of people aren't getting those returns that they need from their brokers. Now, self-directing is managing their own money, right?
Correct.
Now, let's talk about first off, what is the Roth IRA and the traditional, and then I want to get into self-directing them.
Sure. Well, let's talk about the traditional IRA. That is an individual retirement account where the money that goes into it is pre-tax. So you're not taxed on that money until it is withdrawn. And all of the growth within it comes out and is taxed. So it's similar in a way to the 401k. That is also money that goes into the 401k is pre-tax, but again, it's taxed when it comes out. In a self-directed IRA, one of the great benefits there is the elimination of the fees. And one of the things that we ask people when they come into these classes is when you look at your 401k or an IRA, let's say the 401k, how many times are you meeting with an advisor? How many times are there meetings that are held with advice given on what to invest in, how to maybe make changes in what a person is invested in? And most of the time people say, well, we don't have any meetings, but they're still paying fees. What I'm getting at is that for the most part, the retirees are their own managers, their own basically pension fund managers. If a retiree is making the choices, deciding what to invest in, deciding what to change and when to change it, that's basically self-directing. So if you do it in a self-directed IRA, then you eliminate the fees. So you're not paying somebody else basically just to store the money that's in that account. With an IRA, with a traditional IRA or a Roth IRA, and I'll get into that in a minute, the choices are much more varied. In a 401k, the choices typically are mutual funds, exchange-traded funds, and then maybe in some 401ks a stock choice or stock choices, equity choices.
Yep.
It's self-directed. You can still invest in individual stocks, mutual funds, and ETFs if you want, but there are inverse ETFs, which go the opposite direction of the underlying. In other words, if it's an ETF, an exchange-traded fund that mimics the S&P 500, if the S&P is down, the inverse fund will be up a corresponding amount or close to it. So those are available. You can't short in an IRA, but you can use these inverse ETFs, which basically give you the same result. Options can be used. Futures can be used.
So you can use multiple asset classes in there.
Multiple assets, precious metals, real estate, cryptocurrencies, hedge funds, access, private equity, private debt, a number of different things that are just not available in a 401k.
So the institutions aren't just investing in mutual funds or aren't just investing in ETFs.
You would be hard to find an institution that has a lot of money in a mutual fund, but it is what the individual investors that are put into by the advisors, because they collect good fees from mutual funds. Mutual fund, that industry just exploded when 401ks came into existence because that was kind of the go-to investment. Now, in a Roth IRA, the difference there is that the money that goes in, that is contributed to it, is taxed already. So you're paying the tax up front, but everything that comes out of that Roth IRA, the money that was initially invested and all the growth of it, comes out tax-free. So the younger a person is, probably the better that choice would be for them. There's some restrictions, so we want to make sure that you qualify for that. And there are now some 401ks that are Roth 401ks. But that tax benefit is huge. And really what the goal should be is to have the growth of that money be greater than the money that was invested in it, the contributions. And if that can come out tax-free, that's a huge advantage.
Well, it's all about keeping more of what you have. We talked about
That's right.
insurance earlier and protecting what you have, but if there's different opportunities and different strategies with different accounts, and it's just understanding what those are and what they can do. And just going back to, you've mentioned the ETF many times. The ETF is an exchange-traded fund. It's basically, it trades like a stock.
Correct.
But it's essentially like a basket or a bucket of stocks
Sure.
is what it is. So like the S&P 500 has one. There's one for the 10-year bond. There's other ETFs that are out there.
Yeah, I think I had read there's around 7,000 different ETFs. So you can find one that covers anything, whether it's technology or financials, health, any of the individual sectors or industries. You'll find an ETF that will be available for that particular choice.
Yeah, and it's just understanding what the institutions are doing, why there's other accounts and different strategies that the average investor has the opportunity to utilize, especially when you want to, if you want to pick your own account, whether you want to be in a Roth IRA or a traditional IRA. I mean, 401ks are good. I mean, the 401k has taught people how to save. So,
Sure.
that's a good thing.
Right, and the match is free money. If
Yeah.
you're getting a match, that's fantastic.
Mm-hmm. Yeah, the downfall is we're not seeing a lot of people having enough to retire. And the problem, too, is people don't think about it until they're in their 30s or I should say probably their 40s. We're seeing a lot of people not even mentioning or thinking about it until they're in their late 50s, until it's almost too late. But guess what? It is never too late.
No, it's not.
Never too late to learn what the institutions are utilizing. Al, I kind of want to close out the show and just go back to with how these markets work. We talked about at the beginning of the show, at the first segment, supply and demand, but we didn't really put that together as far as multiple directions. We have up, down, and sideways markets. Let's just continue that discussion on how the institutions are utilizing and creating supply and demand, but also creating multiple directional trading.
Well, an institution, if they want to take a position in a stock, let's use Apple, for example, Goldman Sachs is not going to buy 50 shares or 100 shares of Apple. Maybe 1 million shares, 800,000 shares, 2 million shares, something like that. But they cannot get it all filled at one time at the price they want to pay.
Why is that?
Well, for one thing, they know what they want to pay. They know what the value is that they are willing to pay for a particular asset. The more shares that go in, that's demand, that's buying demand. As soon as that huge demand hits the market, the price will start to go up. And one of the reasons is that other traders are going to see, hey, Goldman Sachs just took a big position here. They must know something. We'll get into it. And it just keeps driving the price up and gets away from where Goldman Sachs wants to place the trade. So they want to try to be a little sneaky about it and maybe put out, just several 100,000 shares at a time, enough to move the market, but not enough to get away from the price they want to pay, which means they have several 100,000 more shares, which will come into a buy position when the price gets down to that level. That's where you want to be positioned as an investor or trader to take advantage of the next move up that the institution is going to provide.
Yeah, and that all comes just down to wholesale versus retail. I mean, think about if anybody goes to a store, they want to buy something on sale. Well, that's what the institutions are doing. The public typically jumps on after and buying at retail. So everything that we do in life, you want to do that same thing in investment strategies, because that's what the banks and the institutions and Warren Buffett, the Wall Street, that's what
buying
they're doing.
and bargain basement prices.